Welcome, everyone. We're super excited to continue this FTX series. Before beginning today, I'm just going to read a quick disclaimer that this information is a general description from sFOX only. Before acting on any information, you should consider the appropriateness of it having regard to your particular objectives, financial situation, and needs, and seek advice. No information set out above constitutes advice, an advertisement, an invitation, a confirmation, an offer, or any solicitation to buy or sell any security or other financial credit or lending product, or to engage in any investment activity or an offer of any banking or financial service. With that, I am super happy to continue the conversation that we have with this mini series. If you missed our first one, you can catch the recording on our blog site, and we'll also be sending a recording of this webinar as well. My name is Sarah Tulin, Head of Growth for sFOX, and today we'll be discussing making the market structure safer for institutions and real money players. On November 11th, 2022, FTX said roughly 130 companies in FTX Group, some of the most infamous including FTX Trading, FTX US, and Alameda Research, had started proceedings to file the bankruptcy in the US. The FTX crisis has deterred investor confidence, and a number of questions are standing out. Joining us from the sFOX team, we have Daniel Hinton and John Mannino. It's great to have you both here again. John and Daniel, if you can tell us a little bit about your role here at sFOX.
Sure. I'll start. My name is John Mannino. I'm the Chief Compliance Officer here at sFOX. Our team is responsible for all of the AML and KYC activities, as well as transaction monitoring and ensuring overall general compliance throughout the organization.
Thanks, John and Sarah. Yeah, my name is Daniel Hinton. I'm Head of Operations here at sFOX. My team handles all operational aspects of the business from an internal facing perspective, from our support and client services and success teams, as well as external facing with the various trading partners that we engage with in the market.
Awesome. We have prepared lots of questions today, but I do want to remind all of the attendees on that if you have questions, please feel free during the session to reach out in the Q&A box. We'll be going over some of those as well. We will have the last 15 minutes or so dedicated to answering any of those questions. So don't be shy and feel free to ask any questions in the Q&A section. I also just want to specify that it's the Q&A section, not necessarily the chat bubble. There's two sections there, so that's perfect. And with that, John, based on what we know now, what are some of the red flags other organizations and investors should be looking at?
Yeah, I think that there's been a lot of discussions sort of about this. And, every day as new revelations kind of come out, we learn more and more, and I think our eyes are like, wow. And this just becomes, more and more intriguing. There are three things actually, though, that I do want to kind of call out that, in and of themselves may not necessarily be wrong or illegal. To me, these are specific red flags that I think, any organization should always look at, right? So the first one is crypto companies that issue native tokens and then how they use those native tokens. Again, nothing wrong, nothing illegal about any of this, but it does raise flags, right? If you go back to all the way to the beginning of this, the whole unraveling of FTX, which now seems like so long ago, it was really kind of only, I think, like less than 2 weeks ago now. It really stemmed from the use of their native token FTT and the valuation of that. It became very clear through some due diligence that FTT was being used as a prop to prop up the asset value of a sister company, Alameda. And, it was really to the tune of almost, I think, $14 billion worth of balance sheet asset value that was there. And really, when Binance kind of, began to see this, that's when they really began to, dump and unload FTT into the market. And, and really what that ended up doing was creating an old-fashioned run on the bank, is exactly what really sort of happened. But the whole thing started, right, with just around the valuation of FTT and what that token was actually being used for, right? Because in essence, it was really just being used to prop up the balance sheet for a sister company of FTX. So number one red flag, always question, around companies, crypto companies that issue native tokens and what those tokens are going to be used for. The second thing that I would talk to is overly complex legal structures. Again, this is not something that is necessarily wrong or illegal. This is something that, many, companies can have, and there may be a very, very valid business reason. But when you look at the organizational structure of FTX, right, this had 100 entities, and this covered, subsidiaries, affiliates, 27 different regions across all these things. And you have to wonder and question, right? This is this was a company that had 300 employees. And you're like, why do they have such a complex legal structure? Like, what is the purpose of all this? And the reality was that it was really sort of set up in such a complex way to help kind of mask a lot of these transfers in and out to kind of really help prop up, Alameda and others. And so again, there's some really dubious actions that were occurring there that cause a lot of questions and concerns around why transactions were happening. And it is, when you have that complex of a legal structure, it just makes it harder and harder to track the money, really, is what's happening there. And then the third thing that I would just sort of say, right, was this, this willingness by many in the industry, very, very, some really, really, smart people kind of looked the other way, specifically around SBF and him as the CEO. And, he was really sort of deemed this crypto genius, if you will. And he very quickly became this public face of an entire industry. There was a lot of press around him. He was on magazine covers, all this thing. And I think, what ended up happening is that, people miss sort of some of the fundamentals, and they kind of viewed him as, again, as this kind of crypto genius with this, and not really sort of questioning or thinking, this guy is way smarter than I am, right? He must really understand it. And, these are kind of like basic things that I talk to my team about almost every day, right? It's just that, look, crypto business is complicated, and it is a tough thing to understand, and it's still relatively new. But one of the things that we have to always do is question, right? We need to ask the probing, right questions, and make sure that we understand things, because again, this is really some basics and fundamentals, right? But, if things don't pass the sniff test, then more than likely something is wrong, right? Think back again, to the Bernie Madoff, like, Ponzi scheme aspect of things, right? Those ones were having, positive returns after positive returns after positive returns, right? And people saw what they wanted to see and what they wanted to believe, right? But when you take a step back and you're like, does this really, is this really happening? Does this really pass this sort of sniff test? I always say, if something doesn't smell right, it probably isn't right. And so those were like some three big things that I just sort of saw as red flags in this whole thing.
Yeah, no, that's definitely super helpful. And I think for our audience as well, understanding the red flags that they should be looking out for. I'm curious, Daniel, what some of the red flags you saw from the documents. What are your thoughts on this?
Yeah, thanks, Sarah. Well, John, I was kind of chuckling to myself talking about the entity structure, just one entity per employee and we'll be set,
Right.
Simple, right? Yeah, well, Sarah, one of the great things about seeing a very public process like this unfold is that there's kind of the before time and the after. There are looking in the past when there was more obscurity and not as much clarity around this. But one of the great things with this type of situation is there are a lot of public documents that get produced. And the first thing that I'll just point to came from the newly appointed bankruptcy CEO, John Ray, who also happened to be the same gentleman that took Enron through their own restructuring, a couple of decades ago. So his quote was that, never in my career have I seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information as occurred here. And I really don't want us to underplay that, because literally before this situation occurring, probably the most marquee bankruptcy fraud case in the US would be Enron, right? And it's coming from the same guy. One of the things that kind of harking back to the complexity of their structure is just as one example, when you would wire money to FTX, you wouldn't wire money to FTX Inc. You would wire money to West Realmshires Inc. Right? That level of complexity is kind of manufactured, right? This is not Levi Strauss or some old-time manufacturing company that was founded in 1850 that's transformed over the generations and their business model has changed, but they're still using the old corporate structure, right? This is a company started in 2019, right? So this complexity was manufactured, right? So that's something that people should be on the lookout for. One of the other things which I was kind of disheartened to see was, from the approximately 600 third-party equity investors that were involved in FTX in various ways, none of them performed the basic diligence necessary from an operational standpoint or from a governance standpoint to uncover any of these things. And these are the biggest names in the global investing world, right? People that you would think would have uncovered some of these things. And basically what that tells me is that they saw FTX as a rocket ship and something, an investment where if they were presented with it and they didn't take the opportunity, then their LPs and their investors would look down on them for missing the opportunity. And that's just classic FOMO investing that would lead you to just totally negate deal diligence to any meaningful way, right? From some of the other documents that were produced as part of the first day hearings, many of these companies didn't have board meetings. They didn't have proper employment agreements with lists of who the employees were and the terms of those agreements. So there are almost too many red flags to note from the first day filings. One thing I will comment though on, which I think we'll talk about more later, is that of the various entities that were involved, the US regulated entities, which included several broker dealers, a trust company, and then some CFTC regulated entities, those actually appear to be solvent. So there could be some silver lining here that from a US perspective, those companies were able to come through it without being involved in the bankruptcy.
I think, just to kind of play on that point, right, is just like, at the end of the day, there was some poor lack of, fundamental due diligence done by a lot of counterparties in this space. To Daniel's point around the fact that, I think, just people, again, they believed what they wanted to believe without kind of doing the proper due diligence.
Yeah, no, it's something that we continue to learn from. I'm curious also, Daniel, how have the day-to-day operations of running a prime dealer changed recently?
Yeah, Sarah, that's a great question. So a couple of the areas that have been most impacted are, number one is liquidity, right? Liquidity is the lifeblood of a market. And, from some of the tokens like FTT that we saw, actually they might have a market cap in the multiple billions, but they don't have liquidity. And if you're not liquid, you're dead. So, what we have seen, as an aggregator in the market and somebody who's integrated with, many global exchanges, market makers, and OTC firms, is kind of a strain on liquidity, especially more present in the longer tail altcoins, right? So we've had, increased scrutiny mutually from our various trading partners. We've also seen, the terms of settlement processes change to be a little bit more strict. That manifests itself in, more frequent settlement cycles, lower exposure limits, basically just trying to minimize the time and scale of risk that could be present in the system. And those things are all perfectly reasonable to happen in a time like this of increased scrutiny. We've also seen some firms leaving the market, whether that is due to a direct impact from FTX or just market conditions. So one thing that's really important in a time like this is just access to the market. So having multiple venues that you're able to trade with. And that's something that we've seen at sFOX be a big strength of ours during this time, just because we have so many integrations into the market to still maintain good liquidity in these types of situations. The second thing is just more around client diligence, right? We've probably had more client calls, both new and prospective and current, in the last couple of weeks than we have in quite a while, right? So from the client's perspective, we've had clients much more interested in learning the specifics of our own systems and processes and legal structures and scenario analyses of what happens if if this then that, and we're really happy to have those conversations. So that's kind of one of those other types of red flag things where you should be able to find someone to talk to at the firms that you deal with about these things. Yeah, just also seeing much more interest in kind of the market structure of understanding who your counterparties are in the market and in the way that you are holding or deferring risk to them, right? So probably the best thing that we've seen from this is just that the people that have committed to the space really haven't slowed down their approach, right? We've had a lot of clients that are performing significant diligence and integrations, and they really haven't slowed down. They've actually accelerated their time to market because they know that they need to choose a partner to work with who's going to be there for them in times of need, the same way that we are.
Certainly. And I think that's definitely important to highlight, being able to speak to a human versus some ticket system or never getting an answer back. That is something that I think is crucial, especially during such volatile times. It really seems that all roads lead to regulations. Will FTX implosion lead to crypto regulation, and how? These questions for John.
Yeah. So here's the thing, right? If we look back at where we were kind of in a pre-FTX implosion world, we were moving forward with crypto regulation in and of itself, right? I think, one of the amazing things is that, in a very partisan world that we sort of live in right now, this was viewed as a very, very sort of bipartisan issue, really, with this, right? I think both sides kind of, recognized and realized, and especially in the US, that this was something that was going to be needed, right? And we have, some history kind of, again, sort of with this sort of before sort of everything happened with FTX, right? And so there was a bill that was proposed forward, a legislative bill from Cynthia Lummis, who's a Republican in Wyoming, and Kristen Gillibrand, who is a Democrat in New York. And the reality is that they could not be on more polar opposite ends of the spectrum on things, but they definitely came together in a very, very clear bipartisan way to come forward with some legislation that they believe would really sort of help the industry in this space. I think, what we've seen also in a very short term now, as with Maxine Waters and Patrick McHenry, who are sort of the Democrat and Republican, who are going to sort of switch roles, leadership roles, with the change of the House in kind of the House Finance Committee, are really going to end up, I think, within the next month, really bringing SBF in front of Congress to basically explain really sort of what ended up happening here. So, what does all that really sort of mean? I think what that really means is we were already kind of on this path towards some sort of crypto regulation. And there was, definitely this view, and there's still been a little bit of infighting within the US regulators, around kind of who has jurisdiction over crypto. Is it an SEC perspective? Is it a CFTC perspective? I think what we will see is something that is very, very sort of similar that we saw in the derivative space. So I want to take just one kind of quick step back for a second on a couple little pieces of history here, right? So, right, Daniel mentioned sort of Enron earlier as one of like the largest U.S. bankruptcies, right? The FTX bankruptcy, I think, is going to dwarf that bankruptcy, right? But when Enron collapsed, what we saw, as a result of that was the creation of the Sarbanes-Oxley Act, right? That really sort of looked at governance and structure and internal controls that were sort of associated with that. When Lehman Brothers collapsed, in 2008, and just before that, Bear Stearns and the whole sort of financial crisis, what we saw coming out of that was the Dodd-Frank legislation piece, right? So we have this history, right? Very short-term history of these very major market events really crafting and developing legislation off of the back end of that. Now, again, as I was saying, we had previously, before FTX, we were already kind of on this path of moving forward towards some sort of regulation. I think what we are now going to see is an accelerated path with this, because this was just too big of an implosion to kind of not have some kind of quick action that's there. I think what we're going to just sort of see is probably some joint ownership between both the SEC and the CFTC in this space, where similar to the derivative space, where equity derivatives and single name credit default swaps and those types of things would sort of sit within the SEC's jurisdiction because of them being viewed sort of as securities or having underliers of securities, versus all of the other kind of derivatives like interest rate swaps, those types of things kind of falling within the sort of the CFTC's jurisdiction, which again, I think is going to be where the vast majority of the initial tokens are going to sort of sit under the CFTC jurisdiction. I think what has to happen is some sort of codification within the rules around kind of clearly identifying how companies can ascertain whether a token is neither a security or not a security, which then in turn will drive who has the jurisdiction over that. But I think we're going to see some sort of, registration requirements that are going to be needed. And I think the interesting thing, and again, this is another point that sort of Daniel raised, is this point around the bifurcation between FTX US and FTX.com, where the kind of US sort of regulated arm seems to be in a much better shape. And then I think what you're going to, really sort of see kind of post this is a flight to quality, in the sense that, there's going to, I think counterparties are going to expect, to be able to kind of interact with a company that is going to be registered in the US. They're going to feel safer. They're going to feel secure. They're going to feel that their assets aren't going to be compromised. And so I think that is only going to be a benefit for the client. And I think that's going to be a benefit for the industry as a whole, right? At the end of the day, right, I think, the safety and the soundness of client assets is critical in this space. And that is really what I think regulators are going to be looking for. But more importantly, that's what clients are going to be looking for.
Yep. And John, to that point, I think that those types of questions, asking your service providers, what happens if fill in the blank, those are those are not questions that should be very far down the list when you start looking at who you're going to be doing business with.
Right.
No, it's definitely, all of this as it comes out, we're just learning more and more. I do want to encourage everyone, as a reminder, or anyone that might have popped in late to the session, that we will be doing a Q&A. So if you want to just drop any questions in the Q&A box, we'll be moving on to some of the questions that were asked there. I also want to follow up with Daniel. Many of the FTX red flags have only come out to light after because of the bankruptcy process. How can investors gain more confidence in their trading partners before these types of situations arise?
Yeah, Sarah, this is a very difficult thing to approach, and it's hindsight is always 20/20 for a reason. But there are some very good things that you can do to help yourself ahead of time and deciding the counterparties that you're going to deal with. The first one in my mind is just really understanding, what is the business of the counterparty. In FTX's case, they had these 130 separate subsidiaries who were all engaged in diverse and different lines of business, right? They have an exchange side, they have a lending side, they have a venture side, they have the prop trading side, the Alameda side. And within these types of businesses, it's very easy for conflicts of interest and intercompany dealings to arise. And we saw that happen, kind of across the board with the FTX situation. So, talking to your service providers and understanding the lines of business that they currently operate and that they are, thinking of doing in the future, and just understanding intercompany dealings. Like, for instance, in the FTX case, there were significant intercompany loans to the range of several $billion to, not just to sister entities, but to Sam himself and to other executives of the company, right? So those types of things are pretty significant red flags. Also, just understanding the nature of the relationship. Is this a principal relationship or an agency, right? Or is it even a fiduciary, relationship? There are not many companies in the industry that can operate as a fiduciary. Some trust companies being the main exception to that. But understanding those types of basics will really help you. From a board oversight perspective, first of all, is there a board? Which there was not in a lot of these cases with FTX. Do they meet regularly? Are there independent board members comprised on the board that can really raise these types of issues from an outsider's perspective without being conflicted? And then just thinking about the types of companies that operate in the Bitcoin and crypto space, these are not tremendously large companies, right? FTX was 300 some odd people. Some of the biggest companies in the industry are still in the the low thousands of employees. So get a personal contact. If you don't have the name and phone number of a contact at a company that you're dealing with, I would take that as a red flag, right? You should be able to call someone up, essentially any time of day and have your questions answered, right? So those are a few of them.
Yeah, certainly.
Poor Daniel gets calls all the time.
That's why we have a team.
Yeah, well, we received several different questions that I'm excited to get through, and also want to encourage any other questions people might have to pop them in the box. The first question I have is, coming in, it's kind of a two-part. How many companies have a native token like FTX, as well as is a native token the number one flag to look out for? I think both of you probably have some thoughts here, so I'll let you guys think about that.
Look, I would underscore my initial point with this is just that it's not necessarily the number one red flag, right? And native tokens, there can be a ton of very valid reasons why companies have them and could be used for very, very valid business reasons. The point that I would just sort of underscore is just that you really want to you want to be cognizant of companies that definitely do have them, and you want to really understand the purpose of it, right? And that's really just sort of drilling down a little bit, like, why was the token created? How is it used for? Is it sitting on their balance sheet? How is it being valued? How liquid it is? All of these things that kind of Daniel was talking about. I will just sort of say, here at sFOX, we have a very robust process to onboard tokens that we allow for trading. I will say that FTT was not one that, was one that you could trade on our platform. We go through a very rigorous internal compliance, security, legal, operational review of tokens to identify what makes the most sense and what are the right ones that we want to have on our platform to enable customers to trade with. And we take this very, very seriously. You're not going to be able to trade every single token that you can trade on Coinbase on sFOX. And that is clearly by design, because we take a very, very conservative approach around kind of the types of tokens that we want to trade on, and and its purpose, right? Like, what is the purpose of the token? So I would always just kind of use that as a way to review, and just this kind of stems from my other point around just asking questions, right? So it's flagged, right? So again, not necessarily an issue of itself, but it's a trigger to ask more questions around what is it used for, and what is its purpose really for this.
Right. Yeah, and John, I think this also gets back to the question of understanding what business your counterparties are in. There are some companies whose business model it is to issue tokens, to issue stable coins, to do these things. And that's a different business model than being an exchange or a lender or these other things. So yeah, I think it all kind of ties together nicely.
100%.
Certainly. I have some more questions coming in. John, you mentioned Lehman Brothers earlier. We all remember 2008. Is this crypto's Lehman Brothers moment?
The short answer is like, I can't see how it cannot be.
John, you're kind of hoping it is, right? Because if it's not this,
as I was saying, previously, like, we had Enron, we had Lehman Brothers. I think earlier in the year, there had been, some talk about sort of some of the other things with Celsius and Voyager and all the other kind of things kind of happening. This is by far and away the biggest bankruptcy I think, the US has ever seen. As I said, I really, really feel that this is a major point of inflection within our industry right now. This is going to be a really sort of game-changing moment. And I think, we are going to kind of refer to things on a go-forward basis as, pre-FTX and post-FTX. And, as someone who kind of lived through and has the battle scars from 2008, that was very much kind of how things are in the traditional finance world, where, it was very much around kind of, especially in the derivatives market for sure, which is kind of like where my background was that it was very much, the derivatives market, pre-Lehman and then kind of post-Lehman. And it was very, very different markets, very, very different markets. I think at the end of the day, though, it only strengthened the market. It made it more resilient, it created a stronger trust within the industry. And I think that's exactly what we're gonna end up sort of seeing in the crypto space right now.
Yeah. And Sarah, one aspect that I think about a lot with this is just that, it's one of the great things about our industry is that you have so many choices, right? You have so many choices of what assets you're going to hold, where you're going to custody, self-custody, using a custodian, where you're going to trade. And I think this just re-highlights the need that you cannot outsource those types of decisions. You have to have an opinion on the people and the companies that you're dealing with, because it really is it's going to be your money at the end of the day at risk if you choose wrong. And there really there are no bailouts. People thought that it was FTX coming in to bail out others earlier in the year, but that turns out not to be the case.
No, that's definitely true, and it's a perfect segue into another question that came in on what is sFOX policy dealing with third-party vendors, and what questions should someone be asking their provider?
Yeah, well, this is one of the interesting things that came up in reading through a lot of the FTX documentation, is just the nature to which they outsourced versus internalizing, different functions within their company. So for instance, they did not have an internal accounting department, right? They were not doing, daily reconciliations from their balances to their on-chain, footprints. So, there are really specialized needs for crypto companies, and accounting is kind of, blockchains as an accounting system are kind of at the core of that, right? So not having an internal accounting system, I would see as something, but that goes across the board, right? From compliance to security. There's some things that you kind of have to externalize and outsource, but the things that can be done internally, I think a lot of times it's good to choose to do those that way. Also, just thinking about, the third-party relationships that will exist in any company, from the perspective of valuable data, right? So obviously the financial assets involved here have a lot of value, but also, the client data and client information is very valuable in the wrong hands and in the right hands. So, does the entity have a chief information security officer, right? Do they have a CISO who is going out into the market and doing proactive diligence on vendor relationships, right? Making people sign NDAs if you're going to be doing business with them, performing, your own SOC 1 and 2 audits, but also requesting those of the vendors that you deal with, right? Running DDQ processes on the vendors that you're going to be interacting with. This also gets to the point of kind of wearing too many hats. This was something that I saw, kind of pervasively in the FTX situation, was that, Sam was holding too many of the cards, and there were not enough checks and balances within the organization to allow for these types of processes to develop and for people to own them and share responsibility. And that was really something that hurt him in the long run.
Yeah, and I think that's something that we're all definitely continuing to learn from. We have a few different questions coming through. One is an interesting one. How uncommon were our FTX's actions within the crypto space? Is this something that we've seen before, or what makes this different?
I mean, I think just sort of the level of fraudulent activity that I think we're just sort of seeing here, the really sort of clearly commingling of client funds and and firm funds using client assets for prop trading without kind of customer consent, even when, if you looked at, the FTX terms of service that were sort of even just still published online, clearly identified that, that they were not going to be, they clearly violated that. I mean, there is, some definite criminal fraudulent activity that has occurred here. And this is, it's quite serious. It's not just, it's not just a pure kind of bankruptcy. Like there is definitely some sort of criminal action that has occurred here. And so I think that this, I hope it is much more of an isolated case in the type of things, because I think a lot of these places sort of have good, checks and balances sort of in this, but it's a very, very concerning aspect of things because of the fraudulent activity that was actually being occurred. So it's definitely something that, I think we look at, and I think the industry-wide looks at it as very, very serious.
Yeah, and Sarah, this is one of those unfortunate things that can happen in a bull market, right? Is that a rising tide lifts all boats, and not all of those boats are going in the same direction. So although I agree with John that I don't think this kind of thing is rampant in the industry, it does highlight, one of the unfortunately good side effects of bear markets is that there are no bailouts in this industry, and bear markets will expose fraud where it exists, and there's no way around it when you have to operate on a 21 million Bitcoin standard, and you can't print more Bitcoin to bail yourself out.
Exactly. We have a couple more questions from the audience. One we had come in was, with the lower liquidity available in the market, what risk management procedures has sFOX taken to mitigate against these risks?
Yeah. I mean, it's definitely meant that we have, had to keep a lot more close eye on the trading partners that we deal with. We've managed our pre-funding on the various venues where we do have to pre-fund a lot more closely and routinely. It's also just meant that we have to perform more settlements, right? When exposure limits are decreased and there's just less credit in the market available for use, it means that we have to cycle our funds much more actively to keep those lines of trading available for client use. The good news from a client's perspective is that we still have managed to maintain good liquidity throughout the process, and from a client perspective, there's really no particular way that manifests to you. So from an sFOX client perspective, there's really no change.
Awesome. And we have one last question from the audience coming in. From what we have seen unfold over the past few weeks, John, what will be the future of compliance teams in the crypto industry post FTX? What are your thoughts there?
Yeah, I think the compliance folks have kind of secured their jobs, I think is a good way to maybe put this. But in all seriousness, right, I do believe that, before kind of all this happened, right, strong crypto firms, they were already building, strong compliance teams, right? And they were really sort of pulling the best and the brightest from the TradFi world and kind of bringing them into the crypto space. I think what we're going to see now is more than ever, regulators as well as customers are going to be looking for and demanding strong compliance teams, right? At the end of the day, I kind of view this, within, all of our organizations is that, everyone kind of has a role as a risk manager. And that is, definitely more so in the compliance space now, right? There are, if you look at kind of things, and we're going to go back to FTX for a second, right? And, kind of when everything, right after everything imploded, what happened? The legal and compliance team, they all quit, right? That was really eye-opening. To me, that meant that, right, like they completely missed it, or they knew what was going on and they were looking the other way, right? And that is just kind of completely unacceptable anyway. Like, there are core processes that the AML team, that the compliance teams will always be responsible for, whether that's AML and KYC and transaction monitoring, like the compliance team's sort of bread and butter and kind of what they do sort of day in, day out. But I think there is going to be a need for a compliance team to continue to be the eyes and ears within an organization to help kind of continue to flag any of these issues. And I think, number one, regulators are going to require it. But number two, more importantly, I think customers and clients are going to demand it, right? And they're going to want to know, tell me about your compliance team. What are they doing? How are they combating things? And how are my assets going to be safe, right? And that is the critical piece. And so I just view the role of compliance within an organization only to continue to increase in its importance as the industry kind of continues to grow and evolve kind of past this current situation.
Yeah, certainly. I think this has definitely been the largest learning experience for everyone in the industry, and moving forward, seeing more regulation, seeing clients being more involved with where their assets are going and the company and the structure behind it. This has been super informative. I've certainly